Welcome to ICT for Dummies, episode 11. How to manage your motherfucking risk. If you're in a Ford F-150 and you don't want to crash into a tree, you gotta know how to manage your motherfucking risk. You gotta know how to manage your motherfucking risk.
Alright, shots.
This is how you manage your risk. Let your wins out, weigh your losses. Holy shit, bro. Digital footprint, more like digital shit stain.
What the fuck is up, chat?
Oh my god, you're so fucking dumb.
God, bro. Oh my god. Oh my god.
Oh my god.
Edit this out, editor. Just kidding. Alright, guys. For this episode, we are going to be covering risk management. This is going to be by far, I know I pretty much say this like every episode, but I really do think that this is going to be the most important episode that you guys will ever receive and ever watch. And the reasoning for that, guys, is because you can make, money in the markets. Anybody can make money in the markets by clicking buy or by clicking sell. The reason that people are profitable is because they're able to keep that money that they make. So this is why risk management is so important, being able to keep that money that you make. We're going to show you the models. We're going to show you our whole entire strategy. We're showing you liquidity, all that stuff that you need to know to actually make money. In this lesson, we're showing you how to actually keep that money. That was really gross. And I didn't like that.
So in one word, what Blake was trying to say, it's how you let your wins outweigh your losses.
Sure.
Yeah, that sounds about right. Why is this light so fucking bright?
Let's chill.
Whatever. Anyways, we have it broken down into three big phases because we're assuming 99% of you guys are funded traders or trying to become funded traders, and you're using prop firms. And so it really comes down to three major phases: the eval, the building the buffer process, which allows you to get paid out, and then of course getting your payout. Before you assume that this is all this video is going to be, we're also going to show you how you use that template tool to measure your risk, calculate your risk using minis, micros, all that stuff.
Going through all
because I know a lot of you guys were commenting, how do you know how many contracts to risk and all this shit? Or do you just risk one mini? Do you just risk 10 micros? It's like, no, your risk is always adapting to match a certain percentage, right? So your contract size is always shifting. Anyways, that being said, I guess risk can sort of be subjective in the context of different strategies are going to require a different risk, but we're going to teach you in the proper way. If you're a prop firm trader, ideally you want a strategy with a high win rate, low RR. That's what's going to help you pass accounts consistently, get payouts consistently, et cetera, et cetera. So, of course, it all starts with the eval phase. If we're breaking down the eval phase, there's three major components to it. Well, really two. You have a max daily loss, or just like a max loss limit for that eval account, and a profit target. So most prop firms, how they work is you'll have like a 3%, not 3%, you have a 4%.
3 to 4%.
Yeah, 3 to 4% max loss limit on the account with a 6% profit target. That's how it's going to be for 90% of accounts.
I think we should show them right now what an AlphaFutures account looks like. Show them the actual rules. You can just pause the recording.
Okay, but
or
we'll just do it as we speak right now. How about that? I don't even know how to pause the recording.
All right. Well.
Yeah. Well.
Don't log in.
Okay. Don't log in. Yeah. Scroll down.
So as you guys can see here.
No, they can't see because I'm not showing them, but I'll show them now.
You guys, I got a bunch of comments on the last video said you guys like this more raw style.
So we're keeping it raw.
We're keeping it raw.
I can
completely raw.
I can give it to you raw.
What?
No. What were we saying about alpha?
Okay.
Yep.
So with alpha accounts, guys, you're gonna have a 4% max loss limit. So on for example, let's just do 100K.
Why 50K? I like 50K.
I know, but in the middle, it kind of makes no sense.
Whatever.
You have a 4% max loss limit, and your target is going to be 6%. So again, for 100K, you need to make $6,000.
Yo, you're
sorry. You need to make $6,000, and you can't lose more than $4,000. Okay, and then with this also, you have a consistency rule. So what that means is you cannot make more than $3,000 in one day.
Okay, so let's break this down. Actually showing you trading view.
Yeah.
So go more in depth into this. Let's break down an alpha account, for example. So we have an alpha AlphaFutures D account. Kidding. So funny. And so your max drawdown for this account is going to be 4%. And then on the contrary, your profit target is going to be 6%. Assuming you're utilizing a 1% risk per trade rule here, 1% risk per trade, then, you know, simple math would tell you you can only lose 4 trades. If you lose 4 trades in a row, you blow the account. Obviously, if you
and
win,
you need to also switch models and probably stop trading if you lose 4 trades in a row.
yeah, no, I'm kidding. Guys, it happens where you lose 4 trades in a row.
Possible.
But with these high win, like, that's the whole point why you want lower or high win rate models, because it makes it easier to avoid shit like that.
Yeah.
In comparison to, see, like, a huge problem with people is that you guys think that you need 12 RR and you forget that the trade-off to having high RR is a low win rate. Nobody who has a crazy RR has a high win rate. So if you think about it, if you're trading like a fucking 1 to 10 RR model with a 10% win rate, you're probably going to lose fucking 9 out of 10 accounts that you try to pass. But anyways, back to this. Assuming a 1% risk per trade, you know, if you lose every single trade off rip, you only have 4 trades of room to really work with. And your goal is to get to 6%, which is going to be $6,000 total. So you have to win 6 trades. This is assuming a sequence where everything is consistent. You either lose all 4 or you win all 6. That being said, it's almost never like this where it's perfectly consistent and you win 6 or immediately lose 4. You probably win 1, win 2, lose 1, win 2, lose 1. But that's why you want a high win rate model, because your wins will outweigh your losses, right? And so, yeah, this is like an AlphaFutures. Well, this is any account size, but if we do 100K, this can all be translated towards max drawdown is minus 4%, which if you have a 1/4 of a brain, you can figure out that that's $4,000. And this would be, why is that there? 6%. This would be $6,000. One thing I do want to say is this is, like I said, assuming the 1% risk per trade. The only time I recommend people risk 1% or more on an eval is if you are already profitable. The reason being is because the eval phases are just a waste of time once you are profitable. But since we are talking about how to properly manage your risk here, we're going to assume that you're just like, you know, the average trader, and we're going to give you good advice.
Yeah. Because, guys, if you've already gotten a payout, then there's no reason for you to be wasting your time on these evals. Like, if you've gotten one payout, you reinvest that back into a prop firm, right? And, you know, you understand the model, then you're literally just wasting your time when you could be making money in the live markets with a live account. So that's why we do recommend, you know, 1%. It might look like a lot. You know, you lose 4 trades in a row. That's very possible. But, you know, if you've already gotten that payout, you're reinvesting back into firms, it's really not that much. You know, you're maybe losing like $50. You're maybe losing $100, right? And that's the risk you got to take with these prop firms. You got to treat it like a business model, you know? So you can't be too, you know, anal about, oh my God, I need to be risking 0.25% in an eval phase. Like, if somebody's telling you that, I'm telling you this though, if you're unprofitable, I would definitely say to risk at like the 0.5%. So we'll show you what like the phase 2 and 3 look like. And I want you guys, if you're a complete beginner, never passed a funded account before, and you know you're just putting your feet in the water here, then I would definitely suggest to risk lower, so then you can build that, you know, that muscle of actually having proper risk management.
Yeah, I completely agree. And something I want to put a huge emphasis on, like more so than this just being like us talking to you about prop firm risk, I also want to talk about the fact that if you are a beginner, your whole goal should be to get reps in. You need market experience, so don't try to rush the process with these evals and be like, oh, I'm better than other people despite the fact that I haven't gotten a payout and I don't have like a model that I can consistently trade. Like, your goal should be to get reps and build conviction in a model. So don't focus on making money, focus on passing the counts by following a strict set of rules. And that really should, I mean, we say it all the time. That's the whole goal of trading, to be able to consistently follow a rule set that you give yourself. That's how you build good habits. That's how you build discipline. So once again, if you're a beginner trader, maybe even forget the 1%, have 0.5% risk, which allows you, if we go back to this,
6 trades in a row, guys.
Yeah, you can lose
6.
No, you can. In this case, you can lose 8 trades in a row. Yeah, if you have a 4% drawdown, you can lose 8 trades in a row. But win or loss, it doesn't matter. The point is, it'll help you just build confidence in a model. Anyways, now let's go into like generally how Blake and I manage our risk when it comes down to 3 phases. Well, not Blake and I. This is how you guys should manage your risk. The eval phase. The reason we have 1% for the eval phase is, like we said, it's something we consider to be a challenge that you should be a little bit more, I guess, aggressive with. 1% is a reasonable amount, and we broke down the statistics. It gets you 4 losses if you were to lose everything in a row, like everything at once in a row, or 6 wins. Assuming you have a 1-to-1, 1-to-3 RR model, you'll end up usually winning, and your wins will outweigh more than your losses. And you could have, let's say, 2 trades that are like 1-to-2 RR, risking 1%, which will already put you up 4% in 2 trades if you hit 2 1-to-2s. And you get the gist of that. And the way this is generally how Blake and I trade though. Here, we do max. Oh, this is with evals. Yeah, max 1 trade a day, or 1%. So there's some prop firms that actually only even let you lose 1% a day, or sorry, it's usually 2%. But I would limit yourself to 1%, and this is where giving yourself rules and restrictions is so important because it helps keep your psychology in check. So with the eval phase, you want to be taking the most A+ setups, and risking the same the entire time. So you risk 1%, you take 1 trade a day, win or loss, doesn't matter, you're done for the day. This is going to help you start building that discipline and forcing you to take the highest quality setups. This is how I started, this is how Blake started, this is how we recommend everyone starts. 1 trade a day. It'll build a fucking mental muscle in you that is so important. And I don't know why it says 2 losses done for the day, because we did 1 trade a day.
If you have 1 trade,
yeah.
Then 1
so
loss.
Anyways, it's supposed to say 1 loss, done for the day, 1 win, done for the day. Point is, you learn to call it, you learn to get off the charts when you've already, I guess,
taken your setup.
Setup.
All right. Yeah, so that's that. For phase 2 now, so this is going to be after you've actually passed that eval. Now you're getting to the stage where you're building a buffer. So most prop firms, before you actually go to request a payout, you're going to need a little buffer in play, because when you request that payout, your then account balance is going to go to not 0, but whatever your account balance is, like 50,000 is going to be like your max drawdown, or 100,000 is going to be your max drawdown from whatever your payout was, right? So when we're looking at building a buffer here, again, same thing here with the per trade risk, max daily loss, and profit target. For a per trade risk, I'm looking at a 0.5%. Okay, so again, that's going to give me, with Alpha, that's why I like Alpha so much, because the rules are so good. You're able to lose 8 trades in a row with a 0.5% risk. Most of these other prop firms have about a 3% max drawdown, so that's like 6 trades in a row. Alpha, you can lose like 8, right? And then, so we have these, right? 50K is going to be $250, 100K is going to be $500, and then 150K, you're going to risk $750 per trade. And I want you guys, for every single trade, to risk the same amount, okay? I do not want you to be varying your risk, especially if you're more of a beginner, because you guys don't really truly know at this stage, like, what an A+ setup looks like, what an A setup looks like. So that's gonna be happening when you have more market experience. Like me and Pat were able to, kind of see what an A++ setup looks like from a discretionary standpoint, but also mechanically, and that comes with a lot of screen time.
Oh my god.
What? No.
Hello? Speak?
Hello?
Yeah, but we had the volume nearly at 0.
No, it doesn't matter. That thing doesn't matter.
Oh, really?
Yeah.
How do you know that?
I don't know.
Okay, cool.
Alright, my bad, guys. We thought.
Oh my god, bro. You're gooning my fucking camera.
Oh my god.
I'm gonna hold this shit like this for now.
Alright, so this is mad intimate. So next, guys, we have a max daily loss and a trade rule. Okay, so we have max 2 trades a day. Right, so now that we're risking 0.5%, we can actually take 2 trades a day, which is going to be like a bit of a step up from your 1 trade a day. And this is the thing, guys. If you take 1 win be done for the day. This doesn't mean 2 trades a day, meaning you can take 2 trades a day, right?
It doesn't mean you should take 2 trades
it doesn't mean
a
you
day.
should. But if your setup presents itself twice, maybe the first setup you got maybe stop rated, and then you're looking at, the very similar setup and you want to take it again, then it's going to be okay. Why? Because you have 0.5% risk, meaning now you can risk up to 1% a day.
Yeah, so, I mean, in a scenario like that, let's say Blake and I are trying to take longs right here, right? We know that our max limit that we've set ourselves is 1% for the day. Considering that we're trading 0.5%, let's say this setup fails, but then we get the same setup a few candles later, just shortly after. Well, we've already lost minus 0.5% here, but we still have 0.5% risk to work with here because our max is 1%. And so we can, if the second A plus setup presents itself, it's equally as good, just high quality setup. We still have 0.5% to risk, and then we can take this, and then let's say this hits for like a 1 to 2. Cool. Now we are actually up 0.5%, considering that this hits for a 1 to 2, right? So obviously that's not the case. Maybe your second trade, you're only looking to target a 1 to 1, and you end up break even on the day. But point is, you're calling it, right? You took your 2 trades of the day. You don't need to trade more.
Yeah.
And every single time that I win my first trade, dude, that's like my sign to just get off the charts, go hit gym, and forget about the rest of the fucking day.
Yeah. And there's really there is a reason for this. We don't just say 1 trade a day just because that's what people say, guys. There's a reason behind it, right? So let's say, in terms of accumulation, manipulation, distribution, right? We talked about AMD a lot in this ICT for Dummies series. And when price is actually distributing, right, you're going to be, if you take a good trade, right, and you hit your take profit, what is price doing? Distributing, right? It's a big move up, right, or a big move down, whatever it is. That's going to be a distribution in price. And what happens after price distributes, we accumulate, right? So after that, the session is most likely either taking the objective, right, and price action is just going to be choppy, and you're just going to get caught in that liquidity generation, which is not what you want to be trading. You want to be trading that distribution phase.
I didn't even know we were going to go over this, but this actually happened exactly today.
Yeah,
I was helping someone with it. So, for example, today I took a trade. I'm not going to break down all the confluences for you because that's not the point of this video. But I took a trade. I took a long. I longed right here. And I was able to catch a strong distribution move towards this buy side right here. And so I took a long here. Price ripped up a little bit after. And then I saw a lot of people, whoops, I fucking hate what I do. And then I saw a lot of people, after having a 200-point distribution, try to start taking shorts around this level when a lot of objectives for the day have been met. And this is why it's really important as an intraday, as a futures day trader. And I don't even know if any other person talks about this in risk management, but this is just adding some technicals. And I wasn't planning on talking about this, but it does make sense. If your first trade of the day hits, then that means a drawn liquidity has been targeted, price distributed towards that drawn liquidity, and objective has been met, and that means price distributed, which usually is followed by accumulation. And so I saw a lot of people, after this big move happened, start trying to short after, and look what starts happening with price. It starts going fucking sideways. But yeah, I wasn't really planning on talking about this, but I guess it's, if you guys want to just pair some sauce together.
I think it's definitely necessary just to understand why we actually have that in play. And then also, for 2 losses done for the day, there's also like a reasoning behind this. There's a reasoning behind everything here, right? We don't just say 0.5% because it's 0.5%. No, because you want to have that max loss in play, right? So for 2 losses done for the day, there's really 2 reasons I have this rule in play.
Yeah, one is just risk management, but 2, I know what you're going to say, it's the fact that if you've lost in the same setup twice, your drawn liquidity is most likely wrong on the day, and you're just going to keep getting stopped out, and you're probably emotional by the second trade.
Yeah, exactly. So just like Pat was saying, your edge is not in the market at the moment. You might just have the wrong draw. And then after, 2 losses, your psyche is most likely just going to be cooked, and you want to get off. The second you start feeling emotions in your trading, guys, the second you can start to recognize that is when you should be telling yourself, okay, I'm going to get off here, right? Being able to recognize your emotions is going to be the first step and actually, taking accountability for setting these rules in play, okay? But yeah, that's pretty much why I have those rules in play for the 2 losses. And then we have a profit target also the same, 1 to 1 to 1 to 3.
And when we say 1 and 1, 1 to 3 profit target, by the way, that's just what we have calculated as the average for our strategy. That doesn't mean we're just targeting 1 to 1 to target 1 to 1 or targeting 1 to 3 to target 1 to 3. That's just where 90% of the time our targets are laying.
Yeah.
But yeah, and then the final stage is going to be phase 3, which is payout time. And, as the name implies, this means you've built your buffer and it's ready to pay yourself out, or you can obviously keep stacking the account. So it's pretty much what we're trying to get at with this is once you've established a buffer, this is you now working a bit over the buffer to get a payout. So let's say you built like and so I actually want to write this down real quick. So when we're speaking about a buffer is, I guess, a cushion. I don't even know how to spell cushion. A cushion of capital you maintain to trade comfortably. Yeah, this is actually a perfect definition. So buffer is a cushion of capital you maintain to trade comfortably. If you're like 13 years old and you don't understand what I was just saying and this doesn't sound like English to you, let's put it this way. You're trading in a 100K account, right? And usually if you're trading, can we just use 50? Well, I'll just use 100Ks. You're trading in a 100K account. And a 100K account has 4K drawdown, max drawdown, and 6K profit. Almost always when someone is trying to build a buffer, what that means is that they're trying to get $4,000 in profit for the account and then pay themselves out anything above $4,000 because that was the original drawdown. So ideally, the right way to do this is you get the 100K to $104,000, and now any profits above you can pay out.
And again, guys, the reason this is in play is because after you pay yourself out, sorry, I keep shaking this shit. After you pay yourself out, with what happens with almost every prop firm is your max drawdown will then be the starting point of that account. So, for example, after you pay yourself out, the 4,000 or any profits above 4,000, right? Let's say you paid yourself out.
Let's say we were at like 106,000.
Yeah, and you pay yourself out 2,000, right? Then your max drawdown is going to be $100,000 flat, right? Which means you can then lose 4,000. So you just want your drawdown to be matched with your buffer size, basically.
Paid out 2K, which leaves you with 100. Wow, those are cool buttons I'm pressing. 104K. Once again, so you had 1,600. Those are the profits you made above. So since you got to 106,000. What the fuck? I don't even know what I just said 4 seconds ago, but anyways, you started off with 100K. You built your buffer. Your buffer is $4,000 because that's original max drawdown. And that's just an easy way to calculate your buffer. And so any profits above 104,000, it's reasonable to pay yourself out. Why? Because you're still maintaining that original $4,000 drawdown, right? So let's say you get the count to 106,000 and you pay yourself out 2K. Now you have 104,000. The thing is, when you pay yourself out with prop firms, it usually brings your max drawdown to the original number, which is 100K, which means now that you're at 104K and they've brought it down to where your max drawdown is now 100K, that means you have $4,000 of wiggle room,
which is your original drawdown, right? So, it's subjective. You can, we do recommend to have that drawdown be your buffer. If you want to play it a little more ballsy, pay yourself out maybe 3K, and then you have only 3%. But just know what your max drawdown is after you get that payout.
Yeah, and the reason we're recommending you to go about it this way is because when you do this properly, then you're more able to maintain an account and get multiple payouts. Sure, you can build that account to like 104K and be eligible for payout and pay out fucking half of it or most of it, but now you have like one trade that you lose. If you're risking like 1%, you have like 1 or 2 trades that you can lose before you blow the account, and then it's just like fuck, you know what I mean? That's why it's always good to build that buffer. But yeah, hopefully that made a bit of sense. And then yeah, let's say you do get to like that 104K, right? You built that buffer. That's when I tell people you can up your risk now a bit and maybe go to 1%, because while we were trying to build the buffer, we're usually maintaining like 0.5% risk because we want to be able to hold that account for a bit and just not blow it relatively fast and have good wiggle room. So we try to do like 0.5% when building the buffer. Some people like to be more aggressive. Point is, just build a buffer and be smart about it and maintain consistent risk. If you're going to be aggressive, just be aware that you're being aggressive and try not to, take too many trades, overtrade or whatever. Be smart about it. But like I said, this is how I like to do it. Once I build my buffer, then I up my risk to about 1%, and I can trade more comfortably. Why can I trade more comfortably? Because I know I have that quote-unquote wiggle room. Cool. So that being said, that's pretty much a prop firm breakdown of how you should be managing your risk. I guess this is applicable to other things too, even, I don't know, maybe like a live account if you have something to take away from this. But now what a lot of people were asking us to do is talk about how to calculate your risk with minis and the tool.
I'm gonna just play guitar for me while I do this, but we're going to go on the second portion of the video, guys, which is going to be how to actually place a trade. All right, so you got your risk management down, you wrote down all your rules, and I want you guys to also, with these rules, have a little sticky note. All right, I want you guys to all get your sticky notes or whatever you have. If you have a notebook, do that. But something that you can just look at every single morning, every single day, so you don't break this, okay? I don't want you to ever break your rules for risk management, especially, okay? Now, we're going into how to actually place a trade. So what I want you guys to first note is that 1 mini is equivalent to 10 micros, okay? So if you are trading anything other than a $150,000 account, I would need you to be using micros, okay? This is going to give you the most accurate risk, and just, you shouldn't be trading minis if you're on a 100K or a 50K. If you're on a 150K, then you can use minis, okay? But yeah, anything under that, use micros. It's going to give you the most accurate risk, and you can get your stop loss placement in the best place possible. So you can look at this, guys. I could have kept going on for longer, but you'll get the point, right? 10 points or 40 ticks is equivalent to $200. And this is all with using 1 mini, right? So if I were to use 2 minis, what would this $200 be? $400, right? And then 15 points, this is all with 1 mini.
Or on the contrary, let's say you wanted a 10-point stop. Let's say you have a 20-point stop loss, because on average, if you're trading like a model like ours, your stop loss is typically anywhere between like 20 to 40 points, but let's just say 20 to be safe.
Yeah.
So let's say you're on a 50K, for example, right? A 50K, 1% is how much? $500, right? So let's say you want to take a trade that requires you having a 20-point stop loss. You don't want to risk 1%, so you're probably not going to use 1 mini. What are you going to use? You're probably going to use like 6 micros here, right? Because if you go 5 micros, what are you risking here? You're risking $200. Since 10 micros is $400 with a 20-point stop, 5 micros is $200 with a 20-point stop. But let's say you want it really accurate and you want to risk 0.5%, you're probably going to be anywhere between like 6 to 7 micros.
6, 7.
Oh my God, 6,
7.
7. Yeah. So you get the point.
Micros.
People always say, how many minis should I risk? How many micros should I risk? Are you fucking...
That's like the worst question to ask ever.
That's like saying, how many times should I...
So let's show you guys what that actually looks like on the chart, because I know that's going to be important, right? So I'm going to scroll down to the 1 minute time frame. Oh, it's going to fuck everything up, isn't it? Yep. Okay. So I'll show you guys kind of what it looks like.
You know, if you double, there you go.
Yeah. So I'll show you guys kind of what it looks like going through my head. Okay. So let's.
Bro, that's a trade I took today.
Okay, let's just say we want to take this short. Let's just say we took this short.
Wait, why not the long?
You want to show everyone the trade you took today?
No, just do the short. It's fine. The short's more reasonable.
I know. Okay, so let's say you want to take this short, right? You're taking an inversion, right? And you're going short right here. Okay. IFG. Now, before this even happens, I didn't think I was going to get into this, but I want to get into this now.
What? What are you about to get into? Because I had something important to say.
No, just like how to, you're not going to, let me just talk. It's fine. So, for this, right, we're going to have an 87-point stop. Let's act.
What?
I mean, 87 ticks. Sorry, 20-point stop. All right, and let's act, for example, here that I'm on a 100K account and I'm at, the buffer stage, or I'm at getting the payout phase, right, where I want to be risking 0.5%, consistently 0.5%. Okay, so I'm gonna go in for a sell here, right? But before I do that, I'm going to be calculating my risk, right? So for a 21-point trade, right, for 87 ticks. That's risking about $435 with one mini, right? And, I want to actually be using M and Q here because I think it's going to be just better for you guys to see M and Q. But same thing, right? For the close here and from here, it's 84 ticks, right? Which is 10 M and Q, which is one mini. That's going to give me $420. Now, why is this good, right? You might be saying, Blake, well, I want to risk $500. I want to risk $420. Well, you don't know where this inversion is going to close, right? Which is why you want to give yourself a little bit of room. I would say like around, let's say it closes all the way down here. Then you're risking, let's say 103. Then you're around that $500 mark. A lot of the times with inversions, guys, you're not going to get the exact percentage every single time. But if you're around that $500 mark for 100K for 0.5%, you're good. Just as long as you're around that and you're maintaining that consistently. If it's like, in that range, that's all that matters.
The point this dumbass is trying to get, who sometimes speaks. How'd you know it was gonna close there?
I didn't,
No,
but
yeah,
I didn't,
yeah,
and that's
yeah,
$515. Or and you can see that, maybe you see that really quick, and then you can change to 8, and now you're risking 103, and then boom, or 9.
This is why micros are so good, because you can get your risk
Super
percentage
accurate.
so fucking accurate.
And then like 463, then you're under risk. So as long as you're under risk, just don't be over risk at the inversion.
Yeah. Also, I mean, this is obviously Blake showing you guys how to use this template and calculate your risk and see how many micros to go in. And micros are just going to give you a more accurate risk. But anyways, what I was going to say was, this is based off inversions. I mean, the risk thing still applies. But if you're someone who like trades price tapping into a fair value gap, like let's say we wanted to fucking.
Well, let's show this playing out.
Okay.
This is a little 1 to 2 RR, 1 to 1.79, right? And you have $500 risk, and then you're trying to make $935.
How do you know it's 1.179? 1.79.
It tells you right there.
Oh shit, it's 1.8.
And guys, especially with this though, also, again, we already went over this when we were talking about the profit targets, but we're not like looking for a 1-to-1. We're not looking for a 1-to-2. We're not looking for a 1-to-3, right? We're looking for wherever our drawn liquidity is. So let's say, for example, here, it was all of this trendline liquidity, right? It was this. Did this hit? I don't know. We'll see, I guess. But it was all this trendline. Okay, yeah, I did it. So that's where our target is, right? And that's around like that 1-to-2, 6, 7 range. And it's around that. So what are you going to say?
I was going to say, now, I mean, some of you may trade break a structure, fair value gaps. We trade inversions, but obviously same rule applies. I mean, like, let's say, for example, price is up here, and you're thinking, okay, I want to long when 6, 7. I want to long.
See, that I didn't do it that bad. That was like really bad.
And then you're thinking, like, I want to long when price hits.
Don't do this now.
I want to long when price hits this 4 minute. So let's say you're basing your stop loss off the top of this 4 minute and you have like a limit order. Then let's say this is a big boy trade. 44 motherfucking points, brother. And you're on a fucking 100K. You're on a fucking 100K, which means $1,000 is 1%.
Do a 3-minute gap.
And if you trade, shut up. And if you trade, one mini here, that would be $880. But let's say you want to risk 0.5%, which is $500 here. What I do, I go to MNQ, I go to trade, I see that this is 176. Let's put a limit order right here. Bang. Oh, that's fuck the limit order.
Bang.
Okay, anyways, let's say we have a limit order right here, and the stop loss is 176. So now what I do is I put 176 ticks, and what I want to get my risk to 500. So what I do is, yeah, I know, I realized. I'll finagle with the amount of micro size until I get it to 500. 4 or 5 is practically the same shit, you know. So I can either go 6 here or I can go 5, and it's gonna be around $500. I'm not too worried about a $50 difference.
I mean, for the sake, guys, try to always be like under risking. Like, don't try to be over risking.
Shit.
No, but actually though, because then you're
it's $28 more.
I know, but you need to account for
like one.
You need to account
that's
for
like
fees, and then there's $25 fees probably, and then you're down like 600. Or what if there's a Drake candle that happens and you don't get filled right? It's always better to be safe than sorry.
Holy shit.
But that's just me.
Thank God Mama didn't raise me like a little bitch, bro. Oh my God, bro.
God forbid I use risk management.
22908. 22908.
Yeah, bro, the trade's over, bro. The trade is over.
Can you shut the fuck up for 1 second?
You're not getting your limit.
Oh, this is my take profit.
Yeah, if you take this long, just set up your trade.
Where's my limit order? Anyways, it would have hit my limit perfectly. And then hit my TP because I'm so fucking good at trading. It's crazy. But yeah, you get the point. So you use this tool to calculate your risk. Go use micros is the easiest way to keep consistent risk. I'm hella brain dead today.
Yeah, it's pretty late, guys, but we want to bang these series out for you. But yeah, as you can see here, stop loss here. Oof.
That's 10 micros, bro.
Oh, sorry.
Fucking
I don't know. I tried that.
Account, bro.
Oh, I don't know why I did that. Sorry. There you go. Okay, so then your stop loss here, right here. All right, Bound wants to be a little bit riskier today on this setup. He likes it a lot, so 500 ducks, and 863 TP.
You thought that was funny? 500 ducks. Wait, the fact that you know how to use all these like super zesty tools, it blows my mind. Like, who the fuck knew you can drag your stop loss?
Everybody.
You're a replay mode warrior. Oh my God.
How do you not know how to use this? Anyways, what I also want you. Fuck, bro. What I also want you guys to really take from this video, and this is what we've been emphasizing like since the start, is to be more worried about like how much you're losing like when you're entering a trade. And this is going to be a lot of risk management. Psych talk right now. But whenever I'm entering into a trade, what I'm always thinking about is the potential loss that I can have, right? I'm never entering into a trade and I'm like, oh my God, but I'm going to make this much. No, like I'm always thinking about the loss. And then from that point, if I'm able to go break even, then it's going to be a win in my book, right? Because then the risk is off of the table, right? So always be looking to minimize the amount of risk that you can have every single day, because at the end of the day, that's what's going to make you profitable, being able to keep the profits that you make.
Holy shit, I sharpened us. Say that again. Give like a motivational speech, and I'll give you some sounds over that.
Same thing? Okay. Well, yeah, this is crazy. What I really want to talk about, guys, is just overall with risk management, Stop caring about how much money you're going to make. Don't go into a trade and think, oh my God, but if I make $1,000 on this trade, that's what I'm going to happen. No, go into a trade thinking, I'm ready. I'm allowing myself right now to lose this amount of money. Let's say it's $500. Go into that trade idea. Go into the day being okay with that loss. Okay? Have that mindset ingrained into your mentality. Because if not, when that loss comes, then what's going to happen? oh, you're gonna be like, well, I wasn't expecting that loss. Now my psyche is all fucked. Be ready. All the time, be ready for that, okay? And that's the problem. And that's the true problem with, traders nowadays. It's sad. It's a sad world we live in.
It's a sad, sad world we live in every day. But if you manage your risk properly, you can make a whole lot of money. I remember the days where I didn't have a dollar. I remember the days I was filled with sorrow. Now I've made it to the top. Payouts every day. I can't stop winning. This is how we play.
God, bro. I think I want to quit YouTube.
Holy brain rot.
Yeah, I feel fried. Let's rip the yard pen. Are we still talking about more?
What?
We're still going over more stuff? Okay, end the fucking video.
All right, guys. This is all you need. Real shit, though. Hopefully, you guys learned a lot in this video. A lot of sauce given. Lot of sauce given. Main takeaways.
We're gonna get sued by other fucking traders, bro. They're gonna
Because
be
of how much shit we're
they're
giving
gonna be
out.
like, bro,
For
you're
the free ski.
giving. How much you want to bet?
For the free ski.
2 months down the line, people are gonna be using these videos and selling them. You know what I mean?
But it's not free for YouTube, so you have to be really stupid to do that. With that being said, chat, what is that?
Dude, there's a fucking mosquito on it.
Oh, I see you get that shit off.
Yeah.
Anyways, if you guys took anything away from this video, guys, it would be to use Oh. It would be to use consistent risk all the time, up until you get
your buffer, and then you're eligible to take out a payout. Say it with me. You're eligible to take out a
payout. But also But that's it. That's wraps.
Yeah, just wrap it. Wait, I have a confession to make though. I'm just gonna expose my model right now. Okay, no, I'm just gonna tell you my model. Like practically, what I do every single day is I wake up, I go